If you have told me this a year ago, I would have laughed in your face. 6% net and risk-free savings account in Dubai. This is pretty incredible, even when you compare it with the real estate returns. However, what if I told you that earning 6% risk-free on your cash might actually be stopping you from building wealth? High savings rate, they feel safe. They feel smart. And right now, they look pretty attractive, especially here in Dubai. But after personally testing both strategies, parking money at high interest and investing in real estate, I realized something most people completely overlook when analyzing this too. In this video, I'll break down the real numbers, the hidden advantages on both sides, and why the smartest move today might not be choosing one over another, but knowing when to switch. As always, I'm bringing you the unbiased truth in real estate. So if you like that, hit the thumbs up button, subscribe, and let's get into the video. Let's start with the safe option, high yield savings accounts. Right now, some of the strongest offers I've personally seen is first from WIO, which is a digital bank in Abu Dhabi and is backed by FAB, which is the largest bank in there. It offers 6% saving rate net on your salary account, and with that it requires a minimum salary transfer of 10,000 dirhams and it has a cap of 1 million dirhams. So in principle, if you would be moving 1 million to your WIO account and you will be transferring your salary every single month, then you are eligible and you will benefit from 6% net savings there. In the case of a maximum of 1 million dirhams, then you're actually making around 60,000 dirhams in just interest, and that is safe and net throughout a year. That is honestly quite crazy, because if you look to Europe, you will not really get anything over 2 or 3%. The second option, which is even better, is Mashreq Neo account, and it offers you a 6.25% net savings account. It has the same salary conditions, so you have to transfer your salary to that account, but the only difference is that it has a cap of 500,000 dirhams. So in this case, if you want to start saving your money, then I would probably start with Mashreq Neo, drop all and maximize the maximum cap of 500,000 dirhams with Mashreq Neo. And when I get some extra cash, or if you already have it and you want to maximize the other account with WIO, then you can use that account. So realistically, you can park around 1.5 million dirhams in between around 6 to 6.25% net savings rate. Risk-free, stress-free, and very liquid. That's really strong, no doubt. Globally, even the best savings or money market accounts sit at around 4 to 5% in US and EU. They're often taxed and often temporary, only for a short period of time. And by the way, with WIO, you also have to put it every single month. So there is some active involvement in there. However, it only takes a few seconds. You can just open a savings account every single month on that 6% and just enjoy those returns. Comparing to the global economies, Dubai really stands out because these returns are net and risk-free. So why do the savings feel so attractive right now? High savings rate are generally appealing because there is zero management, zero tenants, zero maintenance, and full liquidity. Psychologically, it feels like free money and it's very easy to do it. But here's the catch. Saving returns are usually linear. Your money earns money, but it doesn't really scale. And caps matter. Once you hit that cap, additional cash earns much less or even doesn't earn anything. So if you actually do have that amount of money, this option could be quite attractive. But if you have a bigger sum of money, you might have to rethink your strategy. Now, let's talk about property without the capital appreciation for now. In Dubai today, realistic gross rental yields on good, well-priced deals, apartments or villas, will bring in around 6 to 8% for ready apartments, and strong cash flow areas can go higher, such as Business Bay, JLT, Al Jadaf, and so on. Net yield, after all the costs are taken out, will be in around 5 to 7%, if this was a full cash investment. So you have the ROI and the net yield based on that. However, in the cases that you get a mortgage, then you might bump up those numbers to 2 digits. At first glance, that looks similar to the savings, right? But this is where the comparison breaks down. Savings accounts don't allow for leverages. However, property does. Let's simplify. You put down 20 to 30%, bank finances the rest. Consequently, the tenant pays your rent and the rent services your mortgage payment. Part of every mortgage payment goes to your principal. That means, in simpler terms, that someone else is simply buying that asset for you. Your net yield is not your net real return. That's why it's important to understand those financial metrics, and for this case, your IRR, which is the internal rate of return, can go much higher within 20 to 25 years of your mortgage. That's because you only invested the down payment, and that, let's remember, that was around 20 to 30%. You didn't put all the price, all the 100% of that property. Yet, you end up owning 100% of the property. This is why professional investors still prefer real estate, even when savings rates are high. So what are the extra property advantages that people usually forget? Here are some of the benefits the savings accounts simply don't offer you. And this, by the way, is really crucial because many landlords forget to count this in. And when you're looking at the rental yields, you might be blindsided by this kind of supplementary benefits. First is paying in check. In Dubai, we are still paying in checks and landlords are receiving the rents in checks. One check means upfront cash for you to use and do whatever you want. 2 checks is semi-liquid because you get half of that annual rent and then you have another half in just 6 months. That upfront rent or cash can be reused, can be put to work, or can be just applied to some other investments. Most landlords usually forget about this because this is actually real money that you can just invest into some stocks and earn another extra 8 to 10%. Secondly, let's talk about the furnished property deposits, because usually when you have a furnished property, you would ask for a 10% deposit, not a 5%. This is usually refunded, but it's usable in the short term. So what does that mean for you as a landlord? You have an extra 10% of that annual rent amount to do whatever you want with it until the tenant either moves out and you need to refund that, or until you have to deduct some expenses from the tenant's deposit and again refund the remaining sum. Nevertheless, my point is that if you have, for example, a case of a 1 check rent payment for a property that has a 100,000 dirhams annual rent, and then you also furnish it and ask for 10% deposit, then you as a landlord literally get 110,000 dirhams right away. And this money can be used straight away, can be parked in another high savings account. You can really leverage this cash. This leads into capital recycling. The rent goes into savings. The savings buy you the next deal, or just sit earning you interest, or just sit in a stock account and also earn you the returns there. Property gives you optionalities, not just the returns. You have many kind of exits and you can play around with it whatever and however you like. Now let's add capital appreciation to that formula. Even if we are conservative, Dubai is still a growing city. Population is rising, supply is controlled by zoning and planning, and long-term demand is now pretty strong because we're not just seeing investors flocking into the city, but we're also seeing more rental contracts and more people actually choosing Dubai as their home base and becoming residents here. So they will definitely need some housing. So even if you might see a slight correction in the short term, over the long term, 20 to 25 years, even modest capital appreciation will massively boost your IRR. While the savings accounts, no capital appreciation, rates will eventually come down because this kind of high rates are not really sustainable for those banks. Returns will reset lower. Real estate, however, rewards time, not timing. So what's my honest take? Well, here's my unbiased opinion. With the market already being pretty high, the best play is probably a combination of both strategies. If you have cash, then park it in high-yield savings accounts and stay liquid until you find that next best deal. Earn 6 or 6.2% while waiting. Be patient. Really, be patient, analyze multiple deals, and deploy that cash only when the deal makes sense. When the right property appears, or you found a really good deal, or someone else simply wants to sell, maybe is in a distress situation, and you actually want to analyze this as a potential investment, that's when you move your money from savings into an asset. Savings in this case become your buffer and opportunity fund. This is why people usually refer to cash as king, because if you have that liquidity, you can actually act accordingly super quick in periods of stress for the markets globally, for local markets, or even in circumstances where people simply need to get rid of their properties or assets, and you are the one who has the liquidity and can take over at a better entry point. And this is where working with the right people matter. If you're looking for well-priced deals, both off-plans and ready, I work with Whim Real Estate, who have access across all cash flow ready apartments, early off-plan opportunities, and distressed or well-negotiated listings. They cover both sides of the market, which is key in this kind of times. So I'll leave all the links in the description below, and reach out to them if you want that next deal to be handled perfectly. And if you want this done fully objectively, I personally also offer a fixed fee sourcing service as part of my advisory company, Agora Advisory. Based purely on your criteria, I source the right unit, negotiate hard, run the financials, and do legal checks to structure that deal for you with a clear exit in mind. In most cases, clients save at least the sourcing fee, making it a win-win for both of us. No pressure, no bias, no endless viewings. So if you want someone to source the right property without any kind of issues and with a real clear strategy in mind for the exit, then reach out. So let's wrap it up. Savings or property? Short-term answer, savings look great. We have to admit that the savings that I mentioned and that are present in this market right now are really high. However, long-term, property always wins. The smartest investors don't choose sides. They use both. As always, bringing you the unbiased truth in real estate. So if you like this video, please hit the thumbs up button, leave your comments in the comment section below. And if this really helped, subscribe. This means a lot, and I'll see you in the next one.